For like a decade, Spotify was essentially the ultimate financial black hole. I
Yeah.
mean, they pulled in hundreds of millions of users, billions of data points, and absolutely zero sustainable profit.
Right. Yeah, none at all.
But if you look at their Q1 2026 numbers, that black hole it turned into an absolute cash-generating juggernaut.
It really did. We are looking at a company that completely re-engineered its underlying business model.
Yeah.
They escaped this massive industry trap, all while we were, just busy making our driving playlists.
Exactly. Now, really quickly, to access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join deepvalues.ai, APP. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store, or Bubble Watch from Google Play. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment financial decisions. Don't forget to like this video. Much appreciated.
Well said.
Okay, let's unpack this, because our mission today is to help you, the listener, really understand Spotify's new business model maturity.
Right.
We're going to break down their structural margins, how they hack their way out of the music industry trap, and ultimately figure out if this company actually qualifies as a deep value investment today at $485 a share.
Yeah, and to really understand that valuation, we have to establish the sheer scale of their current success.
Okay, let's look at the snapshot.
So Q1 2026 was incredibly robust. Total revenue hit 4.53 billion euros.
Wow.
And if you adjust for constant currency, so removing those weird foreign exchange fluctuations, that's a 14% jump year over year.
Which is massive. And the user base reflects that, right?
Yeah.
I mean, they're sitting at 761 million monthly active users.
It's staggering.
Yeah, with 293 million of those being actual premium subscribers.
And the revenue split between those two groups is heavily weighted. Premium brings in 4.14 billion euros.
Which is what, like 90%?
Yeah, 91.5% of their total revenue. Meanwhile, the ad-supported tier brings in just 385 million.
Okay, so if the free tier brings in so little comparatively, why keep it around?
What's fascinating here is that the free tier is basically an engine for the premium side. Over 60% of their premium users actually start on the free tier.
Right.
And it yields this incredible 38.5% conversion rate.
That conversion rate is just absurd. It's like a grocery store handing out a free sample that is so good, almost 4 out of 10 people immediately signed a lifelong contract with the bakery.
That is a perfect analogy. And the reason that sample works so well is their moat. It's what the industry calls the taste graph.
The taste graph, yeah.
Because you have these billions of data points feeding their machine learning algorithms every single day.
Right, curating the exact right playlist.
Exactly. And that creates immensely high psychological switching costs for the user. I mean, people just don't want to lose their curated playlists and their algorithm history.
Yeah, I definitely wouldn't want to start over on a new app. But I do see a crack in the armor here looking at the report.
Huh.
Yeah, if user numbers are up, why did the ad-supported revenue actually shrink by 5% year over year? Like, how does that work?
Well, you're looking at the cyclical vulnerability of the ad market there. The actual impressions they sold went up.
Oh, so they sold more ads.
Right. But broader economic softness completely compressed their pricing power. Advertisers just weren't willing to pay as much per slot.
I see.
But contrast that with the premium tier. That pricing power stayed incredibly resilient across all regions, even with the price hikes.
Okay, so user engagement is super high, pricing power on premium is solid. But that brings us to the next big piece of the puzzle.
Right, the margins.
Yeah. If the model is so good, why did it take a full decade for Spotify to achieve its current record 15.8% operating margin?
Yeah.
I mean, they were famous for just bleeding cash for years.
They were, and that was due to the ultimate structural flaw of the music industry. You have this variable cost trap.
Right, the music royalties.
Exactly. Royalties paid to the big three labels, so Universal, Sony, Warner, and the Merlin Consortium. Those costs scale proportionally with revenue.
So every time Spotify makes a dollar, the labels automatically take their exact cut.
Every single time, which historically capped their gross margins at around 25%. They physically couldn't get more efficient.
So how did they hack their way out of it? Because this Q1 report shows their gross margins hit a record 33.0%.
They found an escape route by strategically investing in non-music audio.
Podcasts.
Podcasts, audiobooks, and marketplace tools for artists. Unlike music, podcasting has fixed upfront costs.
Right, you pay the creator once.
Exactly. And once listener engagement crosses a certain threshold to cover that fixed cost, the incremental margin on the next listen approaches 100%.
That is a massive pivot. And I also noticed their operating expenses fell by 5%.
Yeah, and part of that was heavily aided by this quirky little thing, a 49 million euro favorable variance in Swedish payroll taxes.
Wait, really?
Yeah, it's actually tied directly to their share price movements.
That's hilarious. So the stock moves and their tax bill drops. Plus, they run super lean now, right?
They do. Post layoffs, they have a workforce of roughly 8,524 employees.
Earning what, like an average of $127,612?
Yep. So they are running a very tight ship.
Okay, but here's where it gets really interesting for me. If Spotify is finally proving that this model is highly profitable, aren't the big tech giants just going to crush them?
You mean the Apples and Amazons?
Yeah, Apple, Amazon, Alphabet, with YouTube. They have the balance sheets to run audio streaming as a massive loss leader forever, literally just to sell iPhones or Prime subscriptions.
Right.
How does Spotify survive that?
Well, that is a permanent structural risk. There's no denying it. It places a definitive ceiling on Spotify's pricing power.
Because if they raise prices too much, people just jump to Apple Music.
Exactly. And you also have these complex statutory litigation risks compounding things.
Like the audiobook thing.
Right, the mechanical licensing collective lawsuit. Because Spotify bundled audiobooks into the premium tier, publishers are arguing it changes how music royalties should be calculated.
Man, that sounds like a legal nightmare. So what's stopping big tech from just overwhelming them while they fight these battles?
It comes right back to the taste graph. The algorithm is the only thing keeping big tech at bay. Apple has the money, but they don't have a decade of your specific listening data to serve you the perfect track on a Tuesday morning.
Okay. But still, to build all that out escaping the label trap, building the podcast infrastructure, fighting big tech, that required years of just stomaching massive losses.
Billions in losses, yeah.
So how did management survive Wall Street's impatience? Usually if a company burns cash like that, activist investors just come in and clean house.
They survived because of their very unique corporate governance. And we saw the culmination of this with the massive leadership shift back on January 1st, 2026.
Right, when Daniel Ek stepped down as CEO.
Well, transitioned. He became executive chairman to focus on long-term strategy and geopolitics.
Okay, and he handed daily operations over to the co-CEOs.
Yeah, Gustav Soderstrom and Alex Norström, both of whom are 15-year veterans at the company.
But the ownership structure is the crazy part. Because Ek and his co-founder, Mart Lorentzen, they only own roughly 25 to 28% of the actual economic interest, right?
That's right.
But they hold these beneficiary certificates that grant them over 70.7% of the voting power.
It is absolute control.
I mean, for you listening to this, you have to ask yourself, having founders control over 70% of the vote sounds like a corporate dictatorship. Is that actually a good thing for regular investors?
If we connect this to the bigger picture, it actually is. Top institutional shareholders, like Bailey Gifford with their 4% stake and Tencent with 8.09%, they fully support this structure.
Really? Why?
Because it renders Spotify completely immune to hostile takeovers and activist investors. It allowed management to prioritize long-term infrastructure, like that expensive podcast pivot over short-term quarterly earnings.
Oh, so they could just ignore Wall Street screaming them for not making a profit.
Exactly. And now we are in the capital return phase.
Right, the buybacks.
Yeah. After 10 years of zero buybacks, the April 2026 annual general meeting authorized a massive 10 million share buyback.
That's a huge shift in philosophy.
It is. In Q1 alone, they repurchased 306 million euros in shares. They also retired 1.3 billion euros in exchangeable notes.
And they still have, what, 8.8 billion euros in cash just sitting there?
Just sitting in reserves.
Okay, so that brings us to the ultimate question of this report, the deep value paradox.
Let's hear it.
So what does this all mean? With mature management, record margins, and these massive buybacks, is Spotify actually a good value today at $485 a share?
Well, if you look at traditional Benjamin Graham deep value metrics, it completely fails.
Completely.
I mean, the PE ratio is 34.4x, price to book is 11.4x, the PEG ratio is 2.45x.
And it deliberately ran at a loss for 8 of the last 10 years, so it totally fails the historical earnings per share test.
Exactly. But it passes modern cash generation tests with flying colors.
Okay.
They've had 10 straight years of positive free cash flow. Their trailing 12-month free cash flow is a staggering $3.5 billion. Wow.
Which is an 18.3% margin. Return on equity is 33.2%, and debt to equity is virtually zero at 0.05.
Yeah, trying to value a modern algorithm-based company using traditional price-to-book ratios, it's honestly like trying to value a software company by weighing its physical computer servers. It just doesn't make sense.
That's a great way to put it.
But let's look at the discounted cash flow scenarios you pulled from the report, because I want to push back on the math a bit.
Okay, let's look at the DCF.
So the no-growth intrinsic value is $188.96. Conservative with 6% growth is $368.90. And the nominal scenario, which assumes 15% decaying to 8% growth, gives us an intrinsic value of $603.97.
Right.
So at $485 today, the stock is technically below that $603 nominal value. But it completely misses the required 30% margin of safety price, which would be $422.78.
That's true.
So is this just too risky for a traditional value investor? This raises an important question about how we define value today. We are really looking at a Munger-esque value framework here.
As in Charlie Munger.
Exactly. You are paying a premium, yes, but you are paying it for an unassailable moat.
Because of the taste graph.
Right. And the business is hyper-efficient. Depreciation consumes only 2% of their gross profit.
That's nothing.
It's basically a rounding error. And their owners' earnings are sitting at $2.95 billion. You are paying for a compounding machine that doesn't need heavy capital reinvestment just to survive.
Wow. Okay, so just to recap the journey here, we've watched this company go from a cash-burning music player, totally trapped by record labels, into a highly profitable, dual-tiered audio monopoly.
Yes.
And it was all run by founders who played the ultimate long game.
It really is a fascinating evolution.
It is. Now, before we go, just a quick reminder, if you want to track total market temperature for yourself, definitely search and download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
And as you're doing that, I want to leave you with one final thought to mull over regarding that taste graph moat.
Yeah, the algorithm.
Right. We know it's billions of data points that perfectly map out your preferences to serve you the exact right audio at the exact right moment.
Yeah.
But think about what music really is. It's deeply emotional. If they have mapped your emotional state perfectly, what happens when they leverage that psychological mapping outside of just music and podcasts?
Oh, man.
Right? What else does your Spotify algorithm know about your mental state that you don't even know about yourself?
That is slightly terrifying, but incredibly profound. Thanks for unpacking all of this today.
Anytime.